Hey guys, in this video today we're going to talk about what some of the big banks, Morgan Stanley, Bank of America and Deutsche Bank, what they said about the coming crash in the stock markets. Now this isn't clickbait guys, it's not a huge crash they're calling for, but they're calling for a considerable correction, just as a disclaimer. But in this video, we're going to look at exactly what they mean, what are the dynamics that's causing this prediction they're saying, and why I also think that there might be some truth in it. All right, so let's dig in. So firstly, we're going to look at Mike Wilson. So he is Morgan Stanley's chief US equity strategist. So the chief stocks guy, basically. And basically on the weekend, he was the first one to call a bit of a dip from about, what's the market right now? Maybe just give me a look. Let me have a look. I think it's 4,100 points approximately. He reckons it's going to go to 380 or less. So that's not a big crash. Now, what he said was actually, if you look beneath the surface, there has been a noticeable shift in leadership, which could be telling us something about the reopening that may not be obvious. More specifically, the Russell 2000 small cap has underperformed the S&P 500 since March 12th, peaking in March 12th. So let's have a look at that if my charts loads. Here's one I prepared earlier. So S&P 500 is just very, very bullish. Right, it's straight line up, but let's look at the Russell, which is comprised of the biggest 2,000 stocks, or the 2,000 stocks that are smaller than the ones that fit into S&P 500. So sort of the leftovers, the smaller caps. And you can see here with the top chart here, the daily chart, it hasn't really gone to new highs since March, whereas S&P 500 has rocketed up. So that's a big difference. Look at that. Look at the S&P 500 and now look at the small cap stocks. Big difference. That says something. That definitely says something. What is the market saying? The market's not enthusiastic about buying stocks that aren't mega corporations, that aren't necessarily technologically driven. Stocks that require stores to be open, these brick and mortar stores. I would hazard to say perhaps if you look at Amazon, I think it'd be doing okay. Or maybe PayPal, internet stock. So it's doing good. It's doing, since March, it's been going quite strong. So the mom and pop shops, relatively speaking, the Russell 2000, that's not going so strong. So that's something to look out for. The other thing he's saying is that IPOs and SPACs have been underperforming 20% and are both down for 2021. So that's something interesting to look at too. Let's have a look at Coinbase, which makes a lot because it just IPO'd the day before. Look at Coinbase. That red candle is absolutely, it's hard to explain if we don't get in a smaller time frame chart. So it started at 380. Popped to 420, people buying all the way up to 420, and then it's crashed all the way down to under 320 from 420. So that's a massive drop. That's, I think, from 420 to 320, that's probably about a 25% drop. If you put $1,000 in there, you would have lost $250. That's provided, you sold or whatnot. Maybe you want to hodl it. So that's something to look out for. So there's a lot of shakiness in this market, and I can't disagree with that. The other thing he mentions here is that let me get this straight. So right now, inflation is a big deal. People are talking it up again. I think it had a bit of, the inflation talk had a bit of a lull, I think earlier this year. And towards the mid-end of last year, there was a talk of inflation from stimulus. Everyone was scared and the whole market was fearful about it and pricing inflation in. So you saw stock prices going up, crypto going up, gold going up, less so at the moment, and oil going up, and also raw commodities. Now Mike Wilson from Morgan Stanley is saying this might be coming to bite us right now, because there is actually a supply shortage that we're seeing for most raw commodities in the US, and that means that the prices for those raw commodities are going up. But the businesses, they can't raise their margins, they can't raise their prices that quickly because they're fearful of losing customers. So they're going to have to eat that margin compression for at least a couple of weeks, months, and that means the earnings for next quarter are going to be less. And then what this translates to is a stock price probably going down. So there's a few headwinds right now in the stock market. Now, if you're interested in the stock market, I think he's making good points, and he probably doesn't want to piss off his clients. So, I think, yes, you should take it with a grain of salt, but sometimes this guy has really called it. I wouldn't ignore it necessarily. And, buying on the dips is more or less always good advice than buying on the absolute highs. And right now, the stock market is on absolute highs. We're gonna move on to what another analyst says. We're gonna look at Bofa, Bank of America, the chief quant, Savita Subramanian. Okay, Savita. I know Savita. And she makes 5 points why the S&P 500 will drop to 3,800. Now, you're going, these guys are just trying to scare the small people out of the market. Maybe. Let me preface what she's going to say by explaining that, the banks, they have an incentive to sell stock. They have an incentive for you to be invested in the stock market. But at the same time, they have their models on their spreadsheets or whatever software it is these days, which tells them a price range by which their stock should be valued between this and this range. Now, if the stock price is above their highest estimates, they can't actually recommend it to their clients. They can't buy it themselves because it breaks their risk parameters. And if you watch my Archegos videos and even just be reading around with those articles, once they break the risk management, once it's outside of it, the risk management parameters, they can't, or they're not supposed to do anything with it. So it's in their interest to actually talk the market down so they can buy the stock again once it falls into their range of acceptable stock prices. Right now, what they're trying to say is that this is higher than our models by which we model stocks. So they're saying it's overpriced. And these guys are quite biased in terms of wanting us to buy expensive stocks and wanting to have stock prices high, but it's even beyond their models. Anyway, let's get into the 5 reasons Savita says we might be seeing a downturn. Number 1, sell side indicator is 1 PPT, probably a percent, away from euphoria. And this is their own technical indicator and it's gone since the 80s. And the red line is when it's overbought, the green line where it's oversold, where it's worth buying, and the red line is when you should think about selling. And right now, we haven't been there since 2007, but we're at that red line. I don't really understand how this works because I still feel the market is much, much more overpriced. But according to, this in 2021, it's not that high in terms of bullishness, over bullishness. So anyway, I don't think that adds too much value. The other ones add value. Number 2, the valuations of S&P 500 indicate a 2% return over the next decade. So according to their estimations, you're only going to earn 2% of price increases from this point on, which is probably BS, but it's just saying it's overpriced. Thirdly, this is the one I really want to, in fact, this is the one why I made this video. Outsized 2+ standard deviation returns precedes losses 75% of the time. So I'm not sure if you guys know about what standard deviation is, but it's basically a statistical term for when the data point is on the extremes, near the outliers. And so 2 standard deviations is probably on the extreme 90% extreme. And so once you reach that 90%, once you're at the extreme 90%, you're more than more expensive 90% of the time, then it often precedes a crash. 75% of the time. And the standard deviation is a really classic mathematical measure from Wall Street. If you look at portfolio management, where they sort of think that you calculate the price target for a stock, and then what they do is they use standard deviation to measure the risk, which is the volatility, how much a stock fluctuates before it gets to that price target. That used to be how Wall Street calculates stocks. They calculate this is how much it's going to be worth, and then they go, the risk is how much it shakes before it gets there. That doesn't really make sense. I mean, businesses, anything can happen. They can go bankrupt any moment. Anyway, that's their model, and they use standard deviation for that. And they use standard deviation for stock prices too. So if the stock price is 2 standard deviations above the mean, then they go, no sorry, we're not buying that, we're shorting that. Or if it goes 2 standard deviations below, there are robots that will purposely buy according to that formula. So it's 2 standard deviations means that they already have robots that are telling them to sell right now. That's code for some of our robots are not buying and getting out right now. Number 4, fair value spits out S&P 500 at 3600 basically. This is something to, this is just their calculations, but it's the next one. It's based on this next thing that they want to talk about the most. So the equity risk premium drops below 400 basis points, a contrarian negative signal. And what this actually means is the chart doesn't really add much. So the risk premium is the extra money that you should get for holding stocks compared to bonds. So let's say bonds generate 2% return a year. Your 10-year bond, which is risk-free, gets you 2% yield a year. Fair enough, right? They're not going to lose your money. The government can print out more money to pay you back, so you're not going to lose your money. It's not going to go bankrupt. Fair enough. Now, if you're holding a stock, how much more should you get paid? Well, there is an indicator here that it should be at least 4% more than, for example, the 2% that you should get for bonds, which are risk-free. So hence, you should get a premium for your equity risk that you're carrying, and that should be about 400 basis points, which is 4%. Right now, we're dipping below the 4% mark. So in the scenario where you get 2% for your 10-year, now we're dipping below the 6%. We're making less than 4% more than the risk-free interest rate. So that doesn't really make sense. And every time it's dipped below 400 basis points, which is 4% above risk-free, was in January 2018. And I'm just going to quickly let you see what happened in January 2018. This is what happened. It's going to go, it feels so far back. And it's nothing compared to 2020. So in 2018, let me just get this straight. 2018 in January was when we went past less than 4% on top of the risk-free rate. This is January 26th of January, and then it crashed like crazy. It crashed from 2,900 to around 2,500. So it was about 20% crash plus. No, 10%. But it was, trust me, it was very dramatic during that time. Now it's nothing compared to after COVID. That's what happened the first time round. And then second time round, that we had less than a 4% premium compared to the risk-free, was late 2018. And then this is July, August. I think the article says it's August. September, right? Under 394 basis points. Let's look at what happened. We're in September. Okay, what happens next? Boom. Oh, right. That's interesting. Now, what's the last time it's been less than 400 basis points? Well, I don't know. I think it's probably before the March crash in 2020, but we'll see. Well, yes, we pretty much reached it. If you look at this little trough here, this was just before February, where we sort of had the lowest risk premiums. And now we are at a lower point, and we're probably reaching a lower point. The risk premium that you get, the extra money that you should be getting paid for holding something that's risky like a stock, that's less than where it was before those crashes in January and September 2018. So that's something to look out for. And they didn't have COVID back then. So it was just the market crashing. Now, the final one is Deutsche Bank. And we're going to quickly go into what Deutsche Bank says. Mr. Binky Chadha, I think. And basically reiterating what Mike Wilson said in the first sort of analysis, where the ISM, which is the Institute of Supply Managers, and what they do is they have a survey of like how much it costs to buy the raw materials and how much more materials that they're going to get. And what he said was that it normally peaks about a year after recession ends. So right now, what happens, what he also means by peaking is that this is the best it gets. And then from here on in, it slows down and the numbers that come out are worse. And so what you would actually see is that the growth of the economy is actually starting to slow. And what it starts, and when that happens, when growth slows, the S&P 500 and the stock market, which factors in how much the earnings should grow into their stock price. If that growth, the speed of the companies growing the revenues, that slows down, then you can't get a stock market price that's so high. So right now he's saying that the ISM is dropping faster than what we might be expecting it to be because it's gone up faster and it's peaked faster, right? So we're now in the midpoint of the stock market cycle, the boom cycle almost. We've just accelerated so quickly. I guess everything moves that quickly, these days. I mean, the world's crazy now. Yeah, so I won't go on that too much, but that's what he's saying. And I read it somewhere other place where I think Mike Wilson says. So anyway, Mike Wilson or one of these guys says, so when growth slows, what you want to get into is no longer the small caps and the cyclicals, which is basically the smaller companies which can really, jump on the trend up, or those companies that are like luxury goods, like hotels back in the day anyway, like stuff that you don't really need, but then once the economy starts picking up, it just goes whoosh because you're starting from such a low base where no one's buying luxury handbags, and then now people suddenly are, and then you get a lot of growth and those stock prices go up a lot. But once the economy starts to stabilize a bit and the growth is not as heavy as from the lows of the recession, then it's probably better to get a higher quality company, like a bigger name in the stock market that earns more stable earnings and stable profits. So basically that's what they're trying to say. Move towards quality, less risky names, less of those big risk, big reward names, and more stable companies because they usually perform better in the mid-cycle of a boom. Anyway, I hope you got something out of that and that didn't get too much over your head. But I thought that was really interesting. And, I've sort of made predictions of the stock market before, and they've turned out some right, some wrong. This is me just, looking into what some of the big banks says, these experts that are supposed to be right, we'll see, and giving, a bit of my interpretation about what they're trying to say. But if you look at the stock market, there is no pullback. We have pretty much are pushing up on the highs, but I can show you any time in history whereby it just, they do push, but there are so many times where it does not push any more higher. Big crashes, at least decent pullbacks. I think that's 2013. There's decent pullbacks. There's a big pullback there. Yeah, so there's big pullbacks there. So, these things these things inevitably will happen. So what they're calling for isn't a big crash, isn't too far out of realm of possibility, because we see it so many times. In fact, what's really strange is the fact that there's no crash, there's no drop for a long time. Since November, it's just been going up. We need a drop, because even the big banks are saying it's not healthy, and the economic numbers is coming up should precede a bit of a drop, because they're not going to be as good as we think. Anyway, hope you enjoyed that video. Hope you got something out of it and are able to sort of figure out what you want to do in the stock market or other markets, maybe real estate or whatever you're trying to invest in, or gold, silver, crypto. But right now, today's focus is on the stock market. And I'm looking for a dip myself. What are you looking for? Leave a comment below if you're also looking for a dip. Anyway, with that being said, if you liked the video, hit the like button, subscribe, share with your friends, see what they think about the stock market, what they think about these analyses that were produced by the big banks. And I shall see you in the next one. Take care, guys.